Greetings! You're tuned into House Lux Estate, your go-to channel for all things investment. We're here to equip you with valuable insights into the investment world, providing you with tools to make informed, profitable decisions. Today, we're going to explore a fascinating aspect of investing, how cognitive biases influence investment choices. We'll delve into the depths of our minds, uncovering the hidden biases that may be steering your investment decisions. Stay with us as we delve into this intriguing topic. First, let's unravel the concept of cognitive biases. Now, cognitive biases are essentially mental shortcuts or patterns of thinking that can lead us to form beliefs or make decisions that aren't necessarily grounded in rational thought or factual evidence. Imagine you're at a dinner party and someone mentions a stock that's been on a bull run. Intrigued, you decide to invest without doing any further research. This is an example of the bandwagon effect, a cognitive bias where we tend to go along with what others are doing, often ignoring our own analysis or the lack of it. Or let's say you're scrolling through your social media feed and see a post about a booming real estate market in a particular city. You immediately think about investing there, even though you have no prior knowledge about the market conditions. This is an example of the availability heuristic, another cognitive bias where we base our decisions on the information that is readily available to us, rather than comprehensive research. These mental shortcuts can sometimes be helpful, allowing us to make quick decisions in complex situations. However, they can also lead us astray, particularly when we're dealing with things that require careful thought and analysis, like investments. It's critical to understand that these biases are a part of our human nature. They're ingrained in our thinking and can easily influence our investment decisions if we're not mindful of them. These biases can significantly affect our decision-making process, especially when it comes to investments. Let's dissect one of the most common cognitive biases, confirmation bias. This fascinating mental shortcut occurs when we have a tendency to seek out, interpret, and remember information that confirms our pre-existing beliefs or values. It's like having a filter in our minds that allows us to pay more attention to the information that supports our views, while ignoring or rejecting information that goes against them. Now, let's explore a real-life case study that perfectly highlights the effects of confirmation bias on investment decisions. Picture this. An enthusiastic investor named Jane stumbles upon a tech startup that she believes has great potential. She studies the company, and her research indicates that the startup shows promise. However, in her enthusiasm for the potential win, Jane focuses solely on the positive information she uncovers, and actively dismisses or overlooks any negative or contradictory data. She's not intentionally being dishonest or manipulative, she's simply fallen prey to confirmation bias. Jane's story might seem like a cautionary tale, but it's a common scenario. In the world of investing, it's easy to become enamored with a particular company, industry, or trend. But this infatuation can lead to confirmation bias, causing us to ignore or dismiss crucial information that could potentially affect our investment decisions negatively. For instance, Jane may have overlooked the startup's high burn rate, or the fact that its product is yet to find a market fit. These are important factors that could significantly impact the startup's ability to turn a profit or even survive in the long run. If Jane had been more open to information that challenged her initial positive perception of the startup, she might have made a more informed and balanced investment decision. In the world of investing, confirmation bias can be a costly mistake. It can lead to poor investment decisions based on incomplete or skewed information. It's crucial to approach investing with an open mind, willing to consider all relevant information, not just the information that confirms our initial beliefs or hopes. As you can see, confirmation bias can lead investors to make ill-informed decisions. It's a powerful reminder that in investing, as in life, it's essential to continually challenge our assumptions and beliefs. Next up is overconfidence bias, another prevalent cognitive bias. Let's unpack overconfidence bias, shall we? This bias is essentially when we overestimate our own abilities, knowledge, and skill level. We think we're better or smarter than we actually are. Sounds familiar? It's a human trait that often seeps into our investment decisions. Take, for example, the story of Bob, a seasoned investor. Bob had been in the game for over 2 decades and had seen it all. He was confident, perhaps too confident. He believed his experience gave him an edge over others in predicting market trends. This overconfidence led him to heavily invest in a startup that was, according to his analysis, the next big thing. Bob was so sure of his decision that he disregarded the input from his financial advisors, warning him about the potential risks. He was convinced that his analysis was spot on and that he knew better. But here's the catch. The startup failed to take off and Bob's investment plummeted. This unfortunate incident is a classic example of how overconfidence bias can lead to risky investment decisions. Bob's overconfidence in his abilities and judgment clouded his decision-making process. He overlooked the inherent uncertainty in the market and the potential for failure. Now, it's not to say that confidence is a bad thing. It's not. Confidence is necessary. It helps us take risks and make decisions. But overconfidence? That's a different story. Overconfidence can blind us to potential risks and pitfalls. It can lead us to underestimate the complexity of the market and overestimate our ability to predict it. Remember, the market is an unpredictable beast. It doesn't care how experienced or smart we think we are. It doesn't play by our rules. So while confidence can fuel our investment decisions, overconfidence can lead us down a risky path. So, what's the takeaway here? It's simple. Stay grounded. Be aware of your limitations, listen to others, and never let overconfidence cloud your judgment. Overconfidence bias can indeed be a perilous pitfall for investors. Now that we've examined these biases, how can we avoid them? Cognitive biases, though deeply wired into our brains, are not invincible. With conscious effort and strategic thinking, it's possible to overcome them. Let's delve into some strategies that can help you combat these mental pitfalls and make more informed and rational investment decisions. Firstly, seeking a second opinion. It's easy to get caught up in our own thoughts and ideas. However, by seeking the perspective of others, we can challenge our own assumptions and potentially uncover biases. This could be a trusted friend, a financial advisor, or even a peer group. The key is to choose someone who isn't afraid to challenge your thinking and offer a different perspective. Secondly, diversifying your investments. Putting all your eggs in one basket is rarely a good strategy. By spreading your investments across different sectors, asset classes, and geographical locations, you can reduce the risk of being overly influenced by any single bias. Diversification acts as a safety net, helping to protect your portfolio from the impact of a single poor decision. Thirdly, practicing patience is crucial. The world of investing is often fast-paced and high-pressure, which can exacerbate our cognitive biases. By slowing down, taking a step back, and giving yourself time to fully assess a situation, you can avoid making impulsive decisions driven by bias. Remember, Rome wasn't built in a day, and neither is a solid investment portfolio. Lastly, continuous learning and self-awareness are fundamental. Understanding cognitive biases is the first step to overcoming them. By being aware of these biases and how they influence your decisions, you can actively work to minimize their impact. This involves constant learning, reflection, and self-improvement. So there you have it. By seeking a second opinion, diversifying your investments, practicing patience, and continuously learning, you can actively combat cognitive biases. Remember, it's not about eliminating these biases entirely. That's nearly impossible. It's about recognizing them, understanding their impact, and taking steps to manage their influence. By adopting these strategies, you can make more informed and rational investment decisions. Let's recap what we've learned today. We've taken a fascinating journey into the realm of cognitive biases and how they shape our investment decisions. We've delved into the intricate workings of our minds, unearthing how our own perceptions and interpretations can sometimes lead us astray. We started by understanding what cognitive biases are. They're essentially mental shortcuts or patterns of thinking that can influence our judgment and decision-making. While these biases are a natural part of human cognition, they can significantly impact our investment decisions, often leading to less than optimal outcomes. We then explored two specific cognitive biases: confirmation bias and overconfidence bias. Confirmation bias, as we discussed, is the tendency to search for, interpret, and remember information that confirms our pre-existing beliefs. This can lead us to ignore or undervalue contrasting information, potentially causing us to miss out on profitable investment opportunities. On the other hand, overconfidence bias is the overestimation of our own abilities and the accuracy of our predictions. This bias can lead us to take on risky investments, assuming that we're better at predicting outcomes than we actually are. But it's not all doom and gloom. We also discussed strategies to overcome these cognitive biases. These include seeking out diverse perspectives, challenging our own assumptions, and cultivating a mindset of continuous learning. By being aware of our cognitive biases and actively working to mitigate their impact, we can make more informed, rational investment decisions. Understanding cognitive biases and their influence on our investment decisions is a crucial step towards becoming a savvy investor. With this knowledge, you're not just equipped to make better financial decisions, but also to navigate the complexities of life with greater insight and wisdom. Thank you for tuning into House Lux Estate. Don't forget to subscribe for more insightful content on investments. Until next time, stay informed, stay invested.